Are small banks in America on the brink of a crisis? This isn't a question we ask lightly. In the immense terrain of the American financial system, small and regional banks are not just supporting players. They are the engines driving local economies, the heart pumping the lifeblood of community development and growth. Yet, there is a storm gathering on the horizon, one that could shake the very foundations of these vital institutions. The crux of this looming crisis is a potent brew of factors, each magnifying the risks for small banks. Let's start with the elephant in the room: commercial real estate loans. We're talking about billions of dollars worth of loans, extended in the halcyon days before the pandemic, all set to mature in the year 2024. The uncertainty of the economic climate has cast a long shadow of doubt on the ability of borrowers to repay or refinance these loans. This is not a challenge to be taken lightly. These loans are like ticking time bombs, and the countdown to detonation has begun. The maturation of these loans, combined with an unpredictable economy, is a recipe for a crisis. But the storm doesn't stop there. Rising interest rates, while seemingly beneficial for the profitability of banks, are a double-edged sword. As these rates climb, the value of existing loan portfolios and investment securities can plummet. This erosion can potentially undermine the capital that these banks rely upon to weather financial storms. Regulatory bodies are not blind to these risks. They've issued confidential reports, sounding the alarm, and urging small banks to bolster their defenses by increasing their capital reserves. However, for many of these institutions, this task is easier said than done, as they grapple with the fallout of a turbulent economic landscape. A storm is brewing, one that could shake the foundations of these vital institutions. The question is, how prepared are we to weather this storm? How resilient are these small banks and, by extension, the local economies they support? The coming years will reveal the answers to these questions, and the fate of small banks in America hangs in the balance. Interest rates are climbing, but is this good news for small banks? This is a question that can only be accurately answered a thorough understanding of the financial markets and the role of interest rates in it. To the untrained eye, rising interest rates might seem like a smooth sail for the banking sector. The assumption may be that higher rates are directly proportional to increased returns on loans, right? However, the situation isn't as straightforward as it may seem at first glance. In reality, the dynamics involving interest rates and their impact on small banks are a bit more complex and multifaceted. It's not always about the immediate advantages that higher rates might bring, but also about the potential challenges they could pose. For small banks, the situation could be more of a curse than a blessing. To better understand this, let's unravel the knot by first comprehending the impact of rising interest rates on existing loan portfolios of a bank. When rates rise, the value of existing loans, which were made at lower rates, decreases. This depreciation in value isn't a calculation error, it's an economic reality. This is because new loans issued at higher rates are more profitable for banks. In essence, the bank's assets, its loans, are worth less than they were before rates increased. But this phenomenon isn't merely limited to loan portfolios, it extends to other aspects of banks' operations, such as their investment securities. In the world of finance, banks have a diversified portfolio that often consists of investment securities and bonds. When interest rates go up, the value of existing bonds, which pay fixed interest rates, goes down. Why does this happen? That's because new bonds issued at higher rates are now more attractive to investors. They offer better returns, and hence gain precedence over older bonds. So, just like with loans, the value of the bank's assets, its bonds, also take a significant hit. Now that we have understood the role of interest rates on loans and bonds, let's move to another critical aspect of a bank's operations: the capital reserves. These are the funds that banks set aside as a safety net to absorb losses and weather financial storms. It's their cushion to fall back on during turbulent times. But when the value of loans and bonds decreases, so does the value of a bank's capital reserves. This erosion of capital can put the bank in a precarious position, especially in a volatile economic environment. It can affect their ability to lend further and, in worst-case scenarios, even their survival. So, while it might seem like rising interest rates would be good news for banks on the surface, the reality is that they can also pose significant challenges. The value of existing loans and bonds can decrease, and capital reserves can be eroded, leading to financial instability. This double-edged sword of rising interest rates can put small banks in a difficult position. as they navigate the complex and often unpredictable financial landscape. The impact is felt more by small banks as they have limited resources compared to large financial institutions. Higher rates may not be the boon they appear to be. So as we delve deeper into the intricacies of the financial system, it's crucial to remember that not everything that glitters is gold. It's essential to not lose sight of the complexities and nuances that govern the financial markets. And that rising interest rates, while on the surface may seem beneficial, are no exception to this rule. Each market change comes with its own set of challenges and opportunities, and it's up to the institutions to navigate these in the best possible way. Regulators have sounded the alarm, but what are they doing to mitigate the risks? In the face of these looming threats, regulatory bodies have not been idle. Confidential reports have been circulated, urging small banks to bolster their defenses. The primary strategy being advocated is the strengthening of capital reserves. This is the financial buffer that banks maintain to absorb losses and weather financial storms. But what exactly does shoring up capital reserves entail? Picture a fortress. The capital reserves are like the fortress walls, standing between the bank and potential financial ruin. The thicker the walls, the better the bank can withstand an onslaught of financial challenges. In essence, building up capital reserves means increasing the assets that a bank holds relative to its liabilities. This could involve actions such as retaining earnings, raising additional capital, or even reducing risk-weighted assets. However, the reality of implementing these measures is fraught with challenges. The economic landscape is tumultuous, to say the least. Retaining earnings might seem like a straightforward strategy, but it's not so simple when profitability is under pressure. Raising additional capital can be a tall order when investors are wary of the risks. Reducing risk-weighted assets might involve offloading loans or other assets, a move that could potentially undermine the very role that small banks play in supporting local economies. Moreover, the regulatory landscape is not static. Regulators are constantly reassessing the rules of the game, tweaking capital requirements, and introducing new measures to keep pace with evolving risks. For small banks, navigating this shifting terrain can be a daunting task. In addition to these measures, regulators are exploring other avenues to mitigate the risks. Loan restructuring, capital raising, and even mergers and acquisitions are on the table. Yet each of these options comes with its own set of challenges, regulatory hurdles, and market uncertainties. Fortifying defenses is easier said than done. As small banks grapple with these complexities, the stakes could not be higher. The stability of the financial system hangs in the balance, and the economic well-being of countless communities is on the line. Why should we care about the fate of small banks? The answer lies in the intricate tapestry of our local communities and the national economy. Small banks are more than just financial institutions. They are the backbone of our local economies, the catalysts of our small businesses, and the facilitators of our homeownership dreams. Consider the small business owner who relies on a local bank for the financing to keep their doors open and their dreams alive. A failure of their bank could mean the end of a loan, a closed business, lost jobs, and a community left poorer. Similarly, a homeowner who depends on their local bank for their mortgage could find themselves in financial limbo if their bank collapses. This is the human side of bank failures, the stories that don't always make the headlines but ripple through our communities nonetheless. Now, project these individual stories onto a national canvas. Imagine a wave of small bank failures sweeping across the country. Town by town, city by city, the lifeblood of local economies could be drained away, leaving behind ghost towns where once thriving communities stood. This is not just about economics. It's about the fabric of our society, about maintaining the resilience and vitality of our communities. Beyond the local level, the national economy could also feel the sting. Small banks collectively hold a significant share of the nation's banking assets. If a wave of failures were to hit, it could shake the very foundations of our financial system, potentially triggering a recession or even a full-blown financial crisis. But it's not just about the potential negatives. Small banks also play a crucial role in fostering innovation and competition within the banking sector. Their survival and success can drive bigger banks to offer better services and competitive rates, benefiting all consumers. So, why should we care about the fate of small banks? Because their success or failure impacts us all, From the small business owner in Main Street, USA, to the national economy and beyond, the ripple effects could be far-reaching. What's next for small banks in America? As we look ahead, it's clear that small banks are standing at the crossroads of risk and resilience. The storm clouds may be gathering, but there are strategies that could potentially provide shelter from the tempest. Loan restructuring is one such strategy. By altering the terms of existing loans, banks could potentially reduce the risk of defaults and buy more time for borrowers to regain their financial footing. However, this approach is not without its own set of challenges, as it requires careful negotiation and a keen understanding of individual borrower circumstances. Capital raising is another potential lifeline. By bolstering their capital reserves, banks can build a stronger buffer against potential losses. Yet, in an environment marked by economic uncertainty, attracting additional capital is no easy feat. It requires a compelling value proposition and a clear strategy for navigating the turbulent waters ahead. Mergers and acquisitions offer another potential route to resilience. By joining forces, smaller banks can achieve greater scale, diversify their risk, and potentially gain access to more capital and resources. But let's not forget, this path is strewn with regulatory hurdles and market uncertainties that need careful consideration. As we ponder the road ahead, it's important to remember that this isn't a rerun of the great financial crisis. Yes, there are echoes of the past, but there are also key differences. Today's risks are rooted in a unique blend of factors, from the fallout of the pandemic to the pressure of rising interest rates. Moreover, the regulatory landscape has evolved, with a greater emphasis on risk management and financial stability. In the face of these challenges, the resilience of small banks will be tested. But with proactive strategies and a commitment to risk mitigation, they can navigate the storm and emerge stronger on the other side. The timeline is uncertain, but proactive measures are imperative to safeguard the stability of our financial system. We can't predict the future, but we can prepare for it, and that's the challenge that lies ahead for small banks in America.